Hi, this is Patrick, and you are trading with Prime. Today I'm going to go over how it is that I choose the best option contract. First thing we have to ask ourselves, the very first thing is, what time frame are we trading on? Are we speculating that a stock will be at a certain price by Friday, or are we speculating that a stock will be at a certain price by January or December? And so the first thing I want to do is I'm going to go to the trade tab, and for this analogy, we're going to say Friday. I believe that a stock is going to be trading at a certain price by Friday. And you know what? I believe it's going to be trading at 87 above 87.50. So what I'm going to speculate here is I'm going to speculate this 87.50, and we're actually going to go through here and do the math. 87.50. I'm going to highlight it for you so you can see it. Hopefully that's pretty clear for you. And then something to also consider here, because sometimes people are missing this part of it. Follow my cursor here on the screen. On the top here, you have AMD, the underlying share price of AMD, and then down here you actually have this 87.50 contract itself. And just so you can see here, I'm going to go back to this doji candle right here on the screen, which is 1, 2, 3, 4, 5, 6 days ago, 7 days ago, if you're going to count this, today's candle, 7 days ago. I'm going to go down here 7 days ago. As you can see, we purchased this for close to the same price as the option is worth today. Now, why is that? If the option today is worth $120, why is it that the share price ran up, but the option stayed the same? And that's because of theta, time decay. And so that's something to consider when you're purchasing your options. If you're not buying it on the correct day and you miss the actual buying opportunity, you may either lose money or lose all of your money, lose some of your money, or not make very much money. And so that's part of the key, is to really timing this right and to actually go in here and select the right contract. So in this analogy, what we're going to do is we're going to use this 87 strike 28th of August contract. And so you can see right now that this contract was the bid was 117 and 123 at close, near the close. So what I like to do first is I like to look at the delta, and you can see here 0.44 is the delta. Let's go to this next. Let's go to my actual. Okay, right here you have delta 0.44. Follow my cursor. You also have theta, which is negative 0.20, which also equals negative $20, since every option contract has 100 shares attached to it. So I'm going to gain, instead of 44 cents, I'm going to gain $44 for every underlying move in share price. If the share price moves from $86 to $87, I'm going to get $44 just for the delta. I'm going to go over here. Mark is just the price in between the bid and the ask. I want to know what that price is. I try to beat that price, or I try to come under that price, depending on if I'm selling or if I'm buying. Last, of course, is the last traded price, which is also the mark in this case. Open interest. Open interest is the number of contracts that are out there that have not been exercised. And then volume is the number of contracts that are traded throughout the day. Net change. This is the very first thing I want to see. Net change. I'm paying Joe Schmo, and I apologize if your name is Joe. I'm paying Joe $85 more more than it was yesterday. I'm going to pay $85 more. And I'm going to show you on this screen over here, follow my cursor again. Yesterday, the closing price was around 37 cents, 35 cents. That was the contract price. Then you multiply that by 100. That becomes the overall contract price, or that was the share price, but then you multiply it by 100. That gives you a contract price of $35. Today, around close, that contract costs $120. So you can see it's very lucrative for somebody yesterday to have purchased this and then sold it today. That became very lucrative. But in this case, and it cost them $20 in theta to do that. They lost $20 in value. So in this case, I believe that it's going to be above 87.50 by Friday. And so the first thing I want to know is this: how many days between now and Friday, right? If there's 3 days between now and Friday, I'm going to lose $60. Right off the bat, I'm going to lose $60. Just remember that. This is the price I'm going to lose each day. For every underlying dollar, I'm going to gain $44. So if I took AMD's share price, and this for this analogy, instead of saying it's $86.35, let's just say it's $86 a share. For AMD to go to $87 a share, I'll gain $44. So I'm going to draw a line down the screen. I'll be at $44. Now, what happens if AMD gets to $88? How much am I going to get per share? Or how much am I going to gain in value? Well, what I'm going to do is, for those of you that answered 54, that is correct. And the reason why is every underlying move in stock price, you're going to get an additional 10 cents for gamma. So for the second move, I'm going to get 54 cents, which is equivalent to $54. So a grand total for AMD to go to $88 from where it's at, I'm going to gain $98. Okay. So something to also consider here is AMD to break even on AMD. If it's trading at 86.35, the break even is 2.2%. What that means is I need AMD, let me clear the screen. I need AMD to go from where it's at over here, 86.35 a share. I need it to go to 87.89 by Friday. Okay. That's what I need the share price to be just to break even. That's to make $0 by Friday. And the reason why is what we were talking about. You have theta, time decay, $60 by Friday. Okay, I hope that makes sense. If it doesn't make sense, just possibly go back, rewatch that portion of it. I'll try to slow down here. So that's one thing. That's our first possibility is 87.50 contracts. Okay. Anything else that we wanted to look at right here? Let's go. Oh, this is the other thing to consider. I'm paying Joe, our analogy was Joe Schmo. I'm paying Joe $85, okay? And the reason why I laugh at that name, I have a brother named Joe, so that's what I grew up calling him. Okay, so $85 is our net change. That's the amount that I'm paying Joe. Intrinsic value is $0. What is intrinsic value? That's the value the contract is if it was exercised today. It's worth $0. The reason why you're paying the premium is because this is speculation buying. We are speculating that AMD is going to be higher than it is today. They're maybe not even speculating. There is a possibility that AMD will be above 87.50, and that's where this value comes from. One other thing to consider with this is this. Extrinsic value is lost the minute the contract is exercised. The buyer loses this value, or the one exercising the contract would lose this value. So consider this when you're thinking about exercising a contract. Think of the fees that you have to pay, and then also think of, I'm going to lose this extrinsic value, and that can get kind of expensive right here. This $1.30, that's $130 that you're going to lose right off the bat. So again, the intrinsic value is what the option is actually worth. Extrinsic value are the extra things like time and premium and IV. So as far as our options go, this is one of the options, is paying this $120. Now ask yourself this, if we went through, then we did our calculations and we figured out that we were, I think the total was $98 or somewhere in there that we would gain. Ask yourself this, is risking $120 that we paid for the contract worth? Yes, I know we have unlimited upside potential, but the reality is there's a risk involved here. Is it worth the risk to make $98? Maybe it is, maybe it isn't, and that's for your own trading plan, really. The next one we're going to look at is, another option is up here. You have what are called in the money options. These are out of the money options, and then you have at the money options, which are the two that are closest to the strike price. And then up here you have in the money options. So what we're going to do is we are going to select another one, but this time it's going to be, let's go ahead and use this one right here. It's this, we'll pick this one right here. Okay, again, we can go through this. I know I barely use the calculator here, but so on this one, we're going to choose, again, I'm paying Joe $184. from yesterday to today. And what I can do is I can actually take this contract and I can right click it and I can say send to purple. And here it is. Now you see it on the right hand side of the screen. You already see the difference. You see the difference in these? A little bit wider of a range, right? But you saw it kept its value compared to the other contract, right? As we ran through here, it really kept its value other than this one down day yesterday. For the most part, it kept its value. And the reason why is it's worth more. It has more intrinsic value. Now, again, I'm paying $184 to the guy yesterday. And that's $100 more than if I would have gotten this 87.50 contract. That's $100 more. But what did I gain out of it? This has zero. Oh, where's my little box here? This has zero extrinsic value. It's worth nothing if I was exercising this today. Up here, it's worth $279. That's a huge difference. And you know what? To really think about that in terms of, is it worth more to pay $100? I'm paying $100 extra, or $187, which is $100 more than this contract. Okay. But I'm getting $279 in value out of that. You see the difference? Now, I'm not saying that in the money is better. I'm just saying that there's a difference between values here. Now, of course, it's got less extrinsic value, which is a good thing if you're exercising the contract. Okay. So in this scenario, in this next scenario, let's do the math. This one is going to cost, let me go back to my primes list. This in the money, 184, I'm paying extra. The total cost it cost me, let's do a in the middle price. I got somebody honking outside here. Let's say we're going to choose a price in the middle. Let's say we're going to go with the mark, which is 310. Let's say we paid $310 for this contract. So I'm going to write this on the screen here. $310 for this contract, okay? Now, it's going to give me a delta of 82. Let's say, again, that AMD is trading at $86 out of simple terms. It's trading at $86. Let's say it moves to $87. How much am I going to gain? I'm going to gain $82, okay? Now, on the next move, to go from $86 to $87, what am I going to gain? I'm going to get $82 plus the $10 extra. Oh, I'm sorry. Let me back up here. That's completely incorrect. Let me go back to my... Okay, here we go. So I'm going to go $82. Okay, I'm going to get for delta. And then I'm going to add another 8 cents times 100 is $8. So I'm going to get $90 for the next move. $1 move in stock price from 86 to 87. I apologize. 82, and then this would be 90. 88. Okay. So the next move would be this $90. So you add those together. Just so you guys can see it. 90 plus 82. That's $172. So what else am I going to do? Let's say this all took place overnight. Now what I'm going to do is I'm going to subtract theta, and our theta is $10. So 172 minus $10, $162. So you can see the difference, $162 if I was going to close this tomorrow. Just so you guys know, the break even for this contract, let me clear the screen here. Just so you guys know, the break even for this contract is 0.36%, which is also equivalent. And so remember, this is the 84. This is the 84 strike. Okay. Let me do this. Okay, 84 strike, and we paid $310 for it. Okay. 0.36% to break even, which is also equivalent to $86.30. So you see the difference here. A lot more value on this scenario, in my opinion. There's a lot more value, and it's safer as far as in the money options. Now, again, there's a lot of money that can be made buying out of the money options, and I'm not downplaying the out of the money options. I play them all the time. What I'm just trying to lean into is you get what you pay for. There's a reason why these are cheaper, okay? So in a scenario where, and I know this because we actually took this trade. If I go to charts here, let me get some of this off the screen. Let me get rid of the calculator. Let me unpin these. Let me unpin this one. Just so you guys can kind of see this. We did take this trade. Okay. This is a trade that we actually took with out of the money options. And this is what I want to kind of lean into is you can speculate while we're building energy here. Now, had you purchased back here, you would have spent a lot of money. You would have spent a lot of money. Look at the IV back here. It was, you know, if I draw a little arrow here, look at the IV back here. And then as we built this bull flag pattern, look at the IV. The IV went down. Options got cheaper. So if you time this right on the actual move, you let price consolidate before you purchase the actual option. And that's another thing to actually think about when you're trading options is you want to let it have the time it needs to burn off some of the IV. Let somebody else pay that high IV. It's not worth it. Let somebody else pay the IV. Purchase it before the breakout. You could even purchase it right at the breakout or even a back test, but let it burn off some of its IV. That'll give you the best risk to reward possible. Not only that, you'll make the most amount of money compared to buying it somewhere back here or even back here on this run up. By the way, if you're new here, we have a Discord, and I did put the link of the Discord in the description of the video. And join us Sunday, 5 p.m. Pacific Standard Time. We go over, technical analysis for new traders. We go over plays. We go over stocks. We actually have a stock watch list. If you're getting value out of these videos, be sure and hit the like button, hit the subscribe bell notification so you know when we do go live. And we will see you in the next video.